Interest rates might seem like background noise until they shake the entire market. In this video, we break down interest rates explained, how they impact the stock market. You'll learn why the Fed's decisions matter to your portfolio, how rising or falling rates affect stocks, bonds, and investor behavior, and what to watch for in today's economic climate. Today, we will talk about interest rates explained, how they impact the stock market. So before we get started, make sure to hit that like button, also subscribe to my channel. 1. Interest rates are the cost of borrowing money. At its simplest, an interest rate is the price you pay to borrow money, or the return you earn when you lend money. Banks, businesses, and governments all borrow money by paying interest. When interest rates go up, borrowing becomes more expensive. When rates go down, borrowing is cheaper. Central banks, like the Federal Reserve in the US, set benchmark interest rates that influence borrowing costs across the economy. These rates affect everything from your mortgage to business loans and credit cards. Interest rates are a key tool for controlling economic growth and inflation. 2. Central banks raise or lower interest rates to control the economy. Central banks adjust interest rates to keep the economy healthy. When the economy is growing too fast and prices start rising quickly, inflation, they raise interest rates. Higher rates slow borrowing and spending, cooling down the economy. When the economy slows too much or faces a recession, central banks lower rates to encourage borrowing and spending, which helps economic growth. These decisions have a big impact on businesses, consumers, and the stock market. Investors watch central bank actions closely because rate changes influence company profits and market trends. 3. Rising interest rates often cause stock prices to fall. When interest rates rise, borrowing costs increase for companies. This can lead to less investment in new projects, slower growth, and lower profits. Higher rates also make bonds and savings accounts more attractive, so some investors move money out of stocks and into safer investments. Additionally, consumers might spend less because loans and credit cards become more expensive, reducing company sales. All of these factors often cause stock prices to drop when rates go up. However, the impact varies across industries and companies. 4. Lower interest rates usually help stocks go up. Lower interest rates make borrowing cheaper for companies and consumers. Businesses can invest more in growth, hire more workers, and increase profits. Consumers have more money to spend because loans and credit card payments are cheaper. This boosts sales for many companies, which usually drives stock prices higher. Low rates also make bonds less attractive, pushing investors to buy stocks instead. This combination often leads to rising stock markets during periods of low interest rates. But very low rates for a long time can create risks, like asset bubbles. 5. Different sectors react differently to interest rate changes. Not all parts of the stock market respond the same way when interest rates change. For example, financial companies like banks often benefit from higher rates because they can charge more for loans. Utilities and real estate investment trusts, REITs, tend to suffer when rates rise because they carry a lot of debt, and their dividends become less attractive compared to bonds. Technology and growth stocks, which rely on future earnings, often drop when rates go up because their future profits are worth less today. Understanding these differences helps investors adjust their portfolios based on the interest rate environment. 6. Interest rates affect the value of future earnings. A key reason interest rates impact stocks is because of how investors value future profits. When rates are low, the value of future earnings increases. That's because investors discount those future profits less, making stocks more valuable. When rates rise, future earnings are discounted more heavily, so the stock price today goes down. This is especially true for companies with earnings expected far into the future, like tech startups or companies with big growth plans. Changes in interest rates therefore change how much investors are willing to pay for stocks based on expectations of future profits. 7. Interest rates influence currency strength, which affects international stocks. Interest rate changes can make a country's currency stronger or weaker. Higher interest rates tend to attract foreign investors looking for better returns, which increases demand for that country's currency. A stronger currency can make exports more expensive and less competitive abroad, which can hurt companies that rely on international sales. For international investors, changes in currency values also impact returns. When investing in foreign stocks, currency fluctuations caused by interest rate changes add another layer of complexity and risk. 8. Market expectations of future interest rates drive stock prices. Stock markets don't just react to current interest rates, they react to what investors expect rates will do in the future. Sometimes, stock prices move based on rumors or announcements about possible rate hikes or cuts before they happen. If investors believe the central bank will raise rates soon, stock prices might fall in anticipation. Conversely, expectations of rate cuts often lead to stock market rallies. This means that markets often move ahead of actual interest rate changes, trying to price in future economic conditions. 9. High interest rates can increase the risk of recession. When interest rates get too high, borrowing costs can slow down the economy too much. Businesses may delay investments, consumers may cut back on spending, and economic growth can stall. If this slowdown is severe, it can lead to a recession, when economic activity contracts for a sustained period. Recessions often cause stock markets to fall sharply. Central banks must carefully balance raising rates to control inflation without pushing the economy into recession. This delicate balance makes interest rate policy critical for market stability. 10. Long-term investors benefit from understanding interest rate cycles. Interest rates go through cycles, rising and falling over years. Knowing where we are in the cycle helps investors make better decisions. For example, during rising rate cycles, investors might shift toward sectors that perform better with higher rates or focus on companies with strong cash flow. During falling rate cycles, growth stocks and dividend-paying companies may become more attractive. The key for long-term investors is not to react to every rate change, but to understand the bigger picture. Being prepared for different interest rate environments improves your chances of achieving steady returns. Interest rates are a powerful force shaping the economy and the stock market. They affect everything from consumer spending to business growth, from currency values to investment returns. By understanding how interest rates work and how they impact stocks, you can better navigate market ups and downs. What do you think of our video? Let me know in the comments section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.